Here is a controversial take. Here is an opinion that most people will not agree with. Most people believe that using leverage on top of crypto, on top of Bitcoin or crypto in general, is a bad idea. Most people think that you're gambling away your money. Most people think that you're playing with fire and that it's just a disaster waiting to happen if you use leverage, if you use debt to buy crypto. I don't agree with this. I think that leverage can be a very valuable tool if used correctly. And yes, most people don't use it the right way. But if you do use it the right way, you can indeed amplify your risk-adjusted returns. Now here's the problem, right? Most people just use, say, perpetual futures on a centralized exchange, and they try to time the market of a small altcoin. They try to figure out where's the altcoin going in the next day or two, putting in maybe a 5 or 10x leverage on this, and try to beat the market that way. I agree that it's a bad idea to do that. Most of the time, over the long run, you will lose because you also have the centralized exchanges against you, right? You're betting against the house, basically. But there are ways to use leverage in a smart way. Fundamentally, we have to think about this, right? We have to use our risk-adjusted exposure. The shorter your time period is, usually, the less you can predict the price. Unless you've got very specific information on something that most people don't have, right? If you've got a market edge, very short term, because you know about an event that others don't know about and you can materialize on that knowledge, and of course, short term, you have an edge. But most of the time, predicting what will happen to Bitcoin, say, in the next week, is much harder than predicting what will happen to Bitcoin, say, in the next 10 years. I think most people can agree here that in 10 years, Bitcoin is very, very likely going to be higher 10 years compared to today. But it's very hard to say if Bitcoin will be higher, say, in 5 days from now. So because of that, right, because you've got these long-term trends, because you have short-term volatility, short-term randomness, but long-term trends, you can expose yourself to leverage for the things you have high conviction on. In other words, the way I play this, the way I see this is, the more conviction I have on something, the more I believe that I can predict a certain outcome, the more willing I am to amplify the risk again, to add leverage. So what I typically do, this is not special whatsoever. What I typically do is, when I believe that we are in a bull market in Bitcoin, and I base this on several factors, I base this, for example, on the market value to realized value, I base this on the value that is destroyed. I base this on best back-tested moving averages. I've got my few models that I believe work pretty well. And when I think based on those models that we're currently in a bull market, then I lever up my Bitcoin exposure by 1.3x. So I'm not just 100% in Bitcoin, I'm 130% in Bitcoin. And the way I do this is in two ways. The first way is I use DeFi protocols such as Aave. So I deposit my Bitcoin, my wrapped Bitcoin on Aave. I borrow stable coins against this, and then I buy more wrapped Bitcoin with that. So that's one way to do this. Another way to do this, I've also done this in the past, is to simply just take out a personal loan in a bank. Right? If you currently don't have a personal loan in anything, and you can serve that personal loan very easily because you've got very predictable, stable income, then who says that it's a bad idea to lock in the price of Bitcoin today, let it ride for 5 years, and instead of dollar cost averaging for 5 years every month, you lock in the price today because you believe it's low, and it's lower than 5 years in the future, and you simply just pay off and dollar cost average by paying off that loan over 5 years. Right? Financially, this makes a lot of sense if you believe that the likelihood of Bitcoin being higher 5 years from now compared to today is very high. So this is also a form of leverage, right? You're buying Bitcoin with money that you currently do not have, but you're using your personal loan for something that's appreciating. You're not just buying a random car. Now, most people think this is a bad idea, right? Taking on debt for an investment, especially a personal loan. But people take on personal loans for all kinds of dumb shit, right? For cars, for furniture, for a wedding. There's all kinds of consumer goods that are getting paid with personal loans. But using a personal loan to actually buy an asset, I think, is completely sound, especially if you diversify this with other assets as well, right? Especially if you've got also your exposure to, say, property, or you've got your exposure to stocks, you've got a well-diversified portfolio. Overall, your portfolio is not going to drop by 50 or 60% because correlation between the different assets is relatively low. So sprinkling in some leverage via a personal loan or via a DeFi protocol for very long-term positions, I believe makes sense. You do not want to lever up too much, right? You do not want to lever up by, say, 3x for those long-term bets. Because again, we do not know short-term how much Bitcoin could potentially fall. It can easily fall 30%. So you don't want to overdo this. And when we are currently in a bear market, which we obviously not, right? But when we are bottoming out, then getting in with 1.3x is no problem whatsoever. The same is true, of course, if you've got insider knowledge, right? Or if you just have a market edge. So there's actually a distinction between insider knowledge and simply just knowing more than the rest of the market. Insider knowledge technically is illegal, right? If you know something about the management of a company and say you know about an M&A transaction and you buy before that M&A transaction, you sell after the M&A transaction, then that's obviously illegal. It's also illegal to buy when you know, for example, the year-end results of a company. You buy before, sell afterwards. That's illegal. But what is legal is to simply put in more effort to find the public data in a more concise way, to structure the public data in a more concise way. Right? So, for example, for the M&A transaction, traditional finance, what one could do is one could look up what are the private jets of a certain company. Where's the senior management flying to with those private jets? Are they suddenly flying to a new destination where they've never flown in before? And does that new destination maybe house a competitor? If that's the case, maybe that competitor will get acquired, or maybe there will be some kind of strong cooperation with the competitor and that company, which could also push up the price. So this is hidden data to a degree. It's public data, but not a lot of people look at it. And simply by working a bit deeper, simply by analyzing the data a bit more, you get a market edge. You put in more effort to learn something that most people don't know, and you can materialize, you can monetize that knowledge. And the blockchain obviously is super valuable for this because all transactions are 100% transparent on the blockchain. Right? We can find out who are the wallets that bought this certain asset the first time, or what are the wallets that got some token allocation that might be the wallets of the team, or who bought before a certain coin pumped up and then sold directly afterwards. So what are the wallets that tend to make good calls? Maybe we should follow those. Maybe we should check out what those kind of wallets are doing. Right? So there's all kinds of intel one can make to gain an advantage over the rest of the market. And in those kinds of cases, when you believe that you've got a strong advantage over the rest, a strong edge, then putting in some leverage there, I believe, is also the wise thing to do. Again, of course, in the context of your overall portfolio, not to wreck yourself. You don't want to bet the farm on a single bet, because even if you have, say, a 90% hit rate, which is never the case, but let's say you were the god of traders, you hit 90%. If you always bet the entire farm, then on every 10th trade, you will lose everything. And once you've lost everything, you're done. Right? So you can be the best trader in the world. If you don't manage your risk, you won't long-term succeed. So there's a balance to be made. Most people that use leverage obviously do play with fire. You want to align somewhat the amount of leverage with your conviction of the trade. You want to also more lean towards the side of leverage if you have a very long-term outlook. Right? It's the most normal thing in the world, for example, when we look at property, to go in with super, super heavy leverage. Right? People have like 5 or 10 years of their annual income in debt for a property. This is unheard of in any other asset class, right? Nobody would take out 10 years of their salary to buy Google stock or to buy crypto. But a property is like the most normal thing in the world. Now, this has probably risen historically, right? People simply just needed to finance their house, and houses simply just appreciated so much relative to incomes that this is somehow how we felt ourselves in that situation. But it's also because properties aren't bought and sold that often, as in people do have a long-term time horizon, and people do buy a house maybe to grow their children in them, like to to keep it for 10, 20 years, and to then afterwards sell it maybe for retirement. So because of that long time horizon, people think, okay, when I hold a house for 20 years, the likelihood of it appreciating over those 20 years is very high. Now, one also has to think about this, right? Houses actually do not really appreciate. What actually under the hood here happens is that the debt that you have on your house depreciates relative to your income. So your monthly payments are relatively stable, right? If interest rates don't change. Your monthly payments are the same, but your income rises over time. Now, why is that happening? It's because the money supply itself expands. So when you look at the annual growth rate of US M2, you look at how much does the US monetary base expand on average every year, it's 6.5%. Okay? So when you've got a lot of debt on your house, that debt on the house devalues by 6.5% on average every year. And that's why so many people get rich, comparatively speaking, by owning a house with a mortgage. Just owning a house outright without a mortgage is actually not so smart. But having a lot of devaluing debt on a house is a very smart financial move. And in the same way, I believe it's a smart financial move to have some debt to buy Bitcoin with it, right? To lock in the price today, to then sell it for higher 5 years from now. Now, I'm not saying that current price of Bitcoin is low whatsoever, right? It's somewhere, I'd say we're neither superheated nor we are super depressed. We are somewhere in the gray zone. But because we are in the gray zone and because we still have our upside potential, I'd still believe that if you were to buy Bitcoin today and you would wait for 5 years, the likelihood of Bitcoin being above today's price is super high. Now, I can't put a percentage to how likely it is that it will be higher, but I believe it's higher than 50%. I believe it's a positive expected value bet to do something like this. So don't necessarily go like at least that's my thinking, right? I can't tell you what to do. But my thinking is that demonizing debt altogether is not the right way to go about this. You're at least not maximizing your potential. On the other hand, most people do deal with debt the wrong way. Most people do deal with debt and leverage the wrong way. So what you want to do is you want to find out where could leverage potentially help me without increasing my risk exposure too much. As in, without doing dumb things, without taking a loan to buy a car, or without levering up a small mini altcoin by 20x to hope that it goes to the moon tomorrow, right? Don't do things like this. But you don't have to necessarily only rely on your employment income and take 10% away from this and put this into a 401k, and that's your whole strategy of wealth building. It's better to be a bit more advanced if you want to get ahead, right? The people that get ahead, they do more than others. And they don't necessarily take on just blandly more risk. They don't just bet the farm on something. They think about very smartly how to diversify the risk, how to reduce volatility, but still maximize returns in the same way. And yeah, one alternative for that is, for example, instead of dollar cost averaging, just locking in the price today, have a loan for 5 years. Now, today is not necessarily the best day to do this because, as said, Bitcoin is in this gray zone. And secondly, the interest rates are relatively high. So probably it's not the best time to do this. I currently do not have a personal loan to buy any Bitcoin. But I did open one roughly 3 years ago, and I paid it off over 3 years. And that was a good decision. So think about the market conditions as well, right? It's a bit common sense, but still, if interest rates are 4% rather than 7 to 8% for a personal loan, and if Bitcoin has just crashed by 50, 60% rather than 3x'd from the bottom, right? When things align slightly better, then especially if you do something like this the very first time, then that's the time to get in, right? Don't necessarily do this now if you've never done something like this before, but if you feel comfortable with the risk, of course now probably isn't the worst time either. But if the stars align correctly, then it's of course the best time to do this for the first time, because then there's very little, I believe, that can be done wrong. If you found this useful, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. Last but not least, there's also a Telegram channel. Link is down below. Feel free to join us. Looking very much forward to chatting with you. Cheers.